Hello learners, let us continue with the lesson Risk and Return part 2. I hope you have understood the concepts explained previously. In the previous lesson, we learnt about how to calculate the return from an investment. We particularly understood about holding period return and yield till maturity, and we did some practices also. Now, in today's lesson, we have risk from investment. We will understand about meaning of risk, different types of risk, systematic versus non-systematic risk, and how to measure the risk. As you know, every investment entails some kind of risk. So, let us define what risk is. Risk means the probability of having an adverse return or less returns as compared to the expected return. Suppose you make an investment of rupees 1 lakh today with the hope that by the end of the year it will result into 10% appreciation. But nothing is guaranteed when we make the investment. Now, at the end of the year 1, your actual return may be more than 10%, less than 10%, and in some cases negative also. Negative means you invested 1 lakh, now you are going to get less than 1 lakh. That generally happens in equity market or bond markets. So that's where we say risk means probability of having a loss or chances of having a loss from the investment during the holding period or up till the complete tenure of the investment. Now, the concept of risk can be bifurcated into two parts: systematic risk and non-systematic risk. Systematic risk. Now, this risk concept which we are understanding is particularly with reference to the investment done in the stock market. As you know, investment in the stock market is primarily in the equity shares of the company. Let me give a recap. Equity shares are the one which provide the ownership entitlement to the owners of the shares or holders of the shares. As soon as you buy the equity shares, and if these are listed on the stock exchange, then definitely you can buy more shares on the stock exchange. You can sell more shares if you have with you. Now, buying and selling keeps on continuing on day-to-day basis, and you might notice that prices of the shares fluctuate widely. During a day, many times they go up, many times they come down, but from point to point, if we refer that over a period of 1 year, price might have either gone up or might have come down. Now, you might be surprised why the prices of the equity shares fluctuate too widely, too frequently. Like the ECG graph, when we see the ECG graph, it is going up and down, going up and down. In the same manner, prices go up and down. There are two regions: systematic factors and non-systematic factors. Systematic factors will contribute systematic risk, whereas non-systematic factors will contribute non-systematic risk. Now, let us understand what systematic risk is. Systematic risk means risk resulting from system-wide factors, the factors which affect complete economy, whole of the industry. Those factors will generally have, if they are negative outcome, then definitely it will have negative impact. If they are positive outcome, they will have the positive impact on the share prices. So these factors are the one which are not in the control of an individual investor. No one can control these factors. That is why systematic risk resulting from these factors is called as non-diversifiable. That means it cannot be diversified away. It cannot be eliminated. So long as you remain invested in the market, you will have to bear this level of risk. So let me again define it. Systematic risk means risk resulting from the system-wide factors, the factors which affect whole of the economy, performance of the whole of the economy, either international factors it may be there or domestic factors it may be there. Now, so those factors will generally create systematic risk. I'll come down to the factors little later. Let us first define non-systematic risk also. Non-systematic risk is the one which will result from non-systematic factors. That means either the factors are specific to a particular industry or specific to a particular company. Let us take an example. If suppose government is likely to impose some restriction on the telecom industry, definitely prices of the shares of the telecom companies will come down immediately. Or if government is going to give some concessions to these telecom companies, then prices of these companies will go up and resulting into extraordinary gain or supernormal gain. So factors specific to a particular industry will definitely have impact on the prices of the shares of that particular industry or companies belonging to that particular industry. Similarly, there are company specific factors, like it may be there in a company there is a situation of strike or lockdown, or it may be there is a dispute between workers and the management, then definitely prices of that company's shares will get affected. Or it may be there some heavy duties, heavy taxes are imposed on a particular company, or there is some income tax rate of the ED is there, or ED makes some disclosure that so and so company has done the tax evasion and investigations are going on. Then on that particular day, the moment this news comes, definitely prices of that share will come down or tumble down. That means return from that particular investment will go down. So the factors which are specific to a particular industry or specific to a particular company will affect the performance of that industry or that company only. So risk resulting from that factors is called as non-systematic risk. Now let me remind you, non-systematic risk is also called as diversifiable risk. That means this risk can be diversified away. It can be reduced or eliminated. In certain cases, it can be eliminated completely, because Markowitz theory says the concept or notion of negative correlation can help you in eliminating the non-systematic risk to a zero level. We will learn that also subsequently, but right now it is sufficient enough that non-systematic risk can be reduced with the help of diversification. Now let us go back to the same concept, systematic risk. Now there are many systematic factors or factors which affect whole of the economy. Now what are these factors? Inflation risk. As you can see, the first one we have listed, the inflation risk. So inflation risk will definitely be the risk due to inflation. Now for the last about 2 or 3 years, you can see that central banks or governors of the central banks of across the globe, not even in India, USA also, UK also, Japan also, Germany also, they are struggling to control the inflation. But definitely the moment inflation rises, purchasing power of the money goes down, resulting into the increase in the cost for the company, and the moment cost for the company in general increases, the profit or bottom line will decline. It will have the global impact, that means impact on the whole of the market. Even if a good company is there, the share prices of that will also get affected. Even a bad company or company not performing well, then also the share prices of that company will come down. Therefore, the moment there is a disclosure or fact is known to investors or the regulators, or an announcement is there that inflation is going to go up, then definitely share prices tumble down, resulting into less returns or negative returns. So one factor is risk due to inflation. Another is interest rate risk. As you know, interest rate, whenever a company or an individual makes a borrowing, he has to pay the interest on the borrowed amount. Now maximum companies do the borrowing, they leverage their operations. Now on that borrowing, they have to pay the interest. Now if year on year, month on month or quarter on quarter, rate of interest keeps on increasing. So the increasing rate of interest definitely will have extra burden, extra effect or negative effect on the bottom line of the company. Similarly, increasing rate of interest for individuals will lead to less amount of disposable income or surplus with them, and if less surplus is there, there will be less demand in the stock market for investment, and ultimately in the stock market, increase or decrease in the share prices is all the function of demand and supply. The moment demand for the shares is rising, share prices go up. The moment supply increases and demand decreases, share prices will tumble down. So, dear learners, the moment we come to know that interest rate is likely to go up, share prices come down. And you can see yesterday only the Fed cut down the rate of interest. It will have a positive impact. The moment Fed increases the rate of interest, it will have a negative impact. Similarly, RBI increases the rate of interest, it will have negative impact on the share prices because loan becomes costlier. So, second factor is interest rate risk. These are the global factors, not even the national factors or national interest rate, but international interest rates also affect it, because nowadays markets are interlinked, globalization is there. So, these two are the prominent risks which affect quarter on quarter, month on month. Then another factor you can say, political risk. The moment there is a political instability in an economy, then people are apprehensive that if suppose a new government comes in the market which does not favor the industry, which does not give much of the support to the industry, then definitely industrialists will not set up the new companies, new entrepreneurs will not come, new investment will not get attracted into the country. Due to that, share prices might tumble down or generally tumble down. You can see the scenario few months ago when there were parliament elections. Before the election, people were thinking X government will come. Now, if suppose X government is likely to favor the market means they are pro-market, pro-industry, pro-economy. Pro-economy means they will give some boost to the economy. Then definitely industry will get benefited, and share prices might go up. But on the contrary to that, if X government, which is expected to be pro-government, does not come in the power, definitely share prices tumble down. That's why you can see around the declaration of the election results, share prices move widely depending upon the expectations and outcome of the result of election. So, political risk is the another factor. Now, not even the national level, but international political scenario also affects it. Recently, in USA, we had presidential election. So, those outcomes also have an impact on the Indian stock market or stock market in the rest of the countries, not even in USA, because USA being one of the strongest economy affecting almost all the other economies. So, dear learners, political risk at the national level as well as at international level has bearings on the stock market, and it results into the risk. Then another risk is the market risk. So, we are on the fourth point. 3 points we have discussed about: interest rate risk, inflation risk, political risk, and market risk. Now, what is market risk? Because you are investing in the market, then you might be surprised that why I am saying market risk. But in the market, there are the activities of investors, foreign institutional investors, foreign portfolio investors, HNIs, that is high net worth investors. Now, when these investors create an activity, that means they buy heavily, share prices will go down. When they sell heavily, share prices go down. Sometimes we come to know from the newspaper or from the news items that yes, yesterday foreign institutional investors, FIIs, sold the shares heavily. Due to that, Sensex tumbled down by 500 points, 700 points or 1000 points. It means share prices come down. So, whenever there is a selling price in the market, then definitely things have an adverse scenario. Now, I'll simply explain how the things move in the stock market. Now, let us see that if suppose you might be surprised again why the prices go up and down. So, ultimately it is the demand and supply for the shares. D means demand and S means supply. Demand is created by hope generating factors and supply is created by fear generating factors. Now, take a scenario. If suppose financial institutions or foreign institutional investors are selling heavily, so supply is more and demand is less, and law of economics says whenever supply is more, demand is less, prices will come down. Now, these hope generating factors may be rational. Similarly, fear generating factors may be rational also or irrational. So, ultimately, these are the rational and irrational factors which can either create hope or fear. If there is a hope generating factors, good results, good economic outcome, good monsoon, then definitely demand will be more and share prices will go up. Or if there is a fear generating factor, rational or irrational it may be, then definitely supply for the shares will increase and then the prices of the shares will tumble down, resulting into negative return, that is risk for the investors. So, market trends when they are going up, then definitely prices go up. When market trend is down, bearish trend is there, then risk of loss is there. So, that was the market risk factor. Then similarly, international events, war-like situation, like recently we had Ukraine-Russia war, then definitely the moment there was an outbreak of the war, there was adverse impact on the stock market, not only in India, but across the globe. Similarly, other war-like situation, tension at the border, all those events create negative impact on the share prices, resulting into negative returns. Then comes risk due to general government policies. If suppose general government policies are not pro-industry, they don't provide the facilities, then definitely share prices of the industry will go down. Industrialists will not be interested to set up the industry in India, or foreign investors will not come in India. So, it affects the share prices and in turn resulting into negative return. Natural calamities like flood might be there, drought might be there, all those situations also have negative bearings or negative effect on the share prices. Then monsoon is there. If suppose there is a good prediction about the monsoon, about IMD, then definitely good prediction of monsoon means good crop, and good crop means good income for the farmers, and farmers will generate further demand for the industrial products, thereby leading to increased profit for the industry, increased profit for the companies, and share prices do increase in the hope of larger profit for the companies. Whereas negative prediction, that means monsoon will not be good this year, definitely it has negative bearings or negative effect on the share prices. Industrial growth, definitely every 3 months, 1 month, depending upon the prediction and declaration by the agencies of the government, whenever we predict that industrial growth in the economy is likely to be poor, share prices might come down, or if industrial growth is likely to be good, share prices will go up. So, these are the things. And then lastly, we have scams and malpractices. Sometimes some kind of a scam might be there in the stock market, either in the money market or in the capital market. So, those scams definitely have negative impact. Recently, we had Adani group of company scam came out. Whether it is scam or not, we cannot justify. But yes, the moment the news came about Hindenburg declaration, unearthing something about the Adani group, the share prices not only of the Adani group went down, but across the globe shares of all the companies, all the banks went down. Now, you might be surprised why the share prices of banks went down. Definitely because people were thinking banks might have extended a loan to Adani group. So, this is only an academic lesson I am telling you. So, we are referring to those examples which have recently affected the share prices in the Indian stock market. So, prices of almost all the companies, not only the one particular company which was affected or involved in that, came down, resulting into global loss or across the globe loss for the investors. So, that is how we say systematic risk is created by all those factors which affect the complete system in the economy. Therefore, so long as you remain invested, this cannot be eliminated. So long as you remain invested, this cannot be eliminated. It is something like this: if you don't smoke, but you are traveling in a bus in which rest of the people are smoking, so indirectly you are inhaling the smoke. So that risk you can eliminate only by not traveling in such kind of vehicle. But since you are invested in the market, systematic risk cannot be eliminated. You will have to bear the systematic risk. That is why we say systematic risk is non-diversifiable. So that was all about systematic risk. Now we proceed further with the non-systematic risk. As explained earlier, non-systematic risk is the one which is due to non-systematic factors. That means factors related to one particular industry or one particular company. Now, sometimes a government might come out with an announcement putting restriction on a particular industry. That means share prices of that companies which belong to that particular industry will come down. Or if government gives a favorable announcement, some benefits to a particular industry, then share prices of the companies belonging to that particular industry will go up, leading to the gain for the investors. So, risk due to those factors is called as non-systematic risk. So, what are these particular risk factors? Business risk. When we say business risk, it may be a situation, the factor is specific to a particular company. The company might not be able to operate in the market due to certain conditions. Either it may be climatical condition, poor management of the company, or it may be products are not acceptable to the customers. Due to that, there is no demand, and when there is a low demand, definitely profitability of the company will go down. So, business risk refers to the situation that company is not able to operate in the market. This is also called as operating risk. So, at this point of time, when we say operating risk is there in a company, it means it might be difficult for the company to operate in the market. Conditions may be either within the control of the company management, or it may be beyond the control of the company management. When we say beyond the control of the company management, government might have put some restrictions, society might have discarded those kind of products, or there were restrictions from the international agencies to produce those kind of products. So, in that case, business risk means operating risk also, leading to the decrease in the profits of the company, decrease in the share prices, and resulting into negative return for the investors, those who have invested in the company. Then second type of non-systematic risk is financial risk. Financial risk will originate from the capital structure of the company. Now, let me define at this point of time what capital structure is. Capital structure means composition of different sources of funds used by an investor or by a company to fund its operations. Generally, a company has option to go for the equity issue or debenture issue or a blend of these two. Now, the moment a company has issued heavy amount of debt, that means leverage ratio of the company is more. Leverage means putting more and more debt in the financing of the company. So, whenever debt is more, definitely risk is there. As we know, on debentures, that is debt or a loan, company has a legal and moral obligation or contractual obligation to pay the interest, whether the company earns the profit or not. In that scenario, if suppose company is highly leveraged, that means debt component is more, definitely irrespective of the profits, company will have to pay the interest. Or we can say larger chunk of the operating profit will go towards meeting the interest expenses, and company has the burden to repay the loan also. And another thing, if suppose company has taken a loan or issued a debenture which bears an interest rate of 12%, whereas operating profit of the company is less than 12%, then definitely it will result into decrease in earning per share, resulting into decline in the share prices. So, financial risk will increase from the level of leverage or amount of debt employed by the company in financing its operations. So, that is well within the control of the company sometimes. In many times, yes, it is well within the control of the company whether a company should go for a debt or not. We will learn about the leverage concept in more detail when the topic of financial leverage and operating leverage is dealt with in the later part of the videos or subsequent video which we will see in the subsequent days. So, business risk, operating risk, financial risk or resulting from the financial leverage. Then there are the other factors, risk due to industry specific policies. Sometimes government or the regulators might give restrictions on a company or might give boost to a company or might give favor to the particular industry. Let us say government might say that yes, we will give extra subsidy, extra benefit or soft loan to the fertilizer industry. Definitely all the companies belonging to the fertilizer company will get benefited. Or PLI scheme is there, performance linked incentive scheme of the government is there. So a particular industry gets listed into the PLI scheme, then definitely that industry will get benefited and companies in that industry will be benefited through government scheme, resulting into increased profits or lower costs. So that is the way we say risk due to industry specific factors is also there. Then dispute might be there. Sometimes there may be a dispute between the management of the company and the labor of the company, or within the management there is a split. So that might create a difficulty for the company in operating in the market. Due to that, operating profit or EPS or net profit might come down. So these are the factors which are specific to a particular industry or company. So they are called as non-systematic factors. Now the non-systematic risk is also known as diversifiable risk. That means this kind of risk can be eliminated. Now how we eliminate it? As you can see on the graph, that by adding good number of securities in your portfolio. A portfolio is a bunch of securities held by you, held by an investor at a point of time. So systematic risk remains constant. Whether you are invested in one company, two company, three company or 20 companies, your systematic risk will remain constant because almost all the companies' performance gets affected due to system-wide factors. But the moment you increase the number of securities in your portfolio, non-systematic risk comes down. How it comes down? Because when you say you have invested in 20 companies across different industries, across different industrial sectors, then definitely all the industrial sectors are not going to do poorly or not going to do well. So some industry will do well, some industries will do bad, or some industry will do average. So ultimately a balance will get created and non-systematic risk gets reduced the moment we add a sizable number of securities or investment avenues in our portfolio. So that is how non-systematic risk can be either eliminated or it can be reduced to some extent. So dear learners, that is where we say non-systematic risk is diversifiable, whereas systematic is non-diversifiable. So this is the way we say we have discussed about systematic risk and non-systematic risk. I hope you have learnt about the concept very well. So that is all in this particular part of the conceptual part of the risk. In the subsequent part, that is the next lesson, we learn about how to calculate risk component when we are making investment in the stock market. So my only submission is that keep on learning, because learning leads to enrichment. Learning is enriching. Thank you. Wish you good luck.